again, more social media stuff. Terry, if you want to chime in on what I'm supposed to talk about on these things, but I think these are just examples of some of the YouTube videos and virtual meetings that we have had. Again, you can access any of these via social media. And lastly, our leadership team. These are past presidents and current president. You can see Helen up there. Celebrate as we do the diversity of our leadership team. We're proud of that and continue on that tradition. So with that, I will launch into my presentation. Unless Terry, you had any other announcements or questions?
No, Tim, you're doing fine.
All righty. Of course, I need to figure out how to get my slides up here, so hang on one second. Slideshow. This always comes a little tricky when I have more than one. Yep, sorry about that. Hang on one second. All right, so I'm going to share that screen, which is right here. Can you see that, Terry?
I see it perfectly.
Perfect. Okay, and it's changing okay. Yes? All right. I'm going to take that as a yes, Terry. Okay. I get no other interaction. So what we're here to discuss today is the actually the effective date of Proposition 19, which occurred 2 days ago, February 16th. We just had a mad scramble of clients who, number one, were trying to understand the changes that were wrought by Prop 19, and two, how to respond to them. And because of this February 16th date, we just had a flood of activity and questions, and any attorney who had any knowledge or bandwidth in this area was just quickly sucked up into the vortex of this planning. And primarily the questions revolved around, what do we do prior to the effective date? Should I be transferring my principal residence? Should I be transferring real property? And well, I think all those are great questions. They really can't be answered in a vacuum. And I had clients who had great difficulty in trying to decide whether or not a transfer of real property made sense now or in the future without really analyzing the effects that it had on their personal finances, their estate planning, and their tax planning. So what we're going to cover today is the aftermath of some of that last minute planning. And some good news is that we do have some tools and techniques that are available to help you plan around Prop 19. They were actually around before the passage of Prop 19, and now they're becoming more important. And we'll see how this can be done not only in a vacuum, but needs to be done in conjunction with your overall estate plan. And we'll talk about some techniques there. And then what I'm going to do is, time permitting, I am going to give you a little update on some current tax events that have occurred. One being on the 1031 exchange front, as far as final regulations, and I do have an update on taxation of PPP loans for California purposes. So again, my name is Tim Tikalsky. I'm a principal with Sensiba San Filippo. I head our real estate practice. I've been practicing for 40 years now. I was an adjunct professor at Cal State East Bay for about 10 years where I taught the master's program up there. I am a CCIM, and so I am very focused on not only the taxation of real estate transactions, but the investment side of that. Does this investment make sense? How do you know whether or not you have the right investment or the mix of investments? Just like you would do with your stock portfolio, I try to guide my clients into diversifying their real estate investments. I do have 2 acknowledgments that I'd like to make. So this presentation is actually a repeat, albeit solo by me, of a presentation that was done yesterday with 2 of my dear friends and colleagues, Teresa Flugel from Chicago Deferred Exchange and her boss, Mary Cunningham, and Ryan Lockhart, who is a partner with McKenna Brink Seniorati, almost worse than Tikalsky. And anyway, Ryan has been very key in guiding me and my clients through the maze of property tax reassessment and the like. So many of these slides are reproductions of those slides, and I'd like to give acknowledgement to those people as well. So what we're going to cover today is basically 4 or 5 areas. Prop 19 was basically in 2 parts, and we're going to cover both the good part and the bad part. One involves the transfer of personal residence, the other involves transfers of all other real estate. We're also going to talk about a technique to avoid or at least defer property tax reassessment with the use of a limited liability company. And then for those clients who want to transfer property but don't want to give the beneficiaries the ability to go to Vegas and blow all the money, there is a technique that is commonly used today called an intentionally defective grantor trust, which gives the grantor some limited control over what the beneficiary does with the assets. And then lastly, as I said, we'll, time permitting, give you a quick update on Section 1031. So Prop 19 was a little bit of a smoke and mirrors, I think, with respect to voters. There was a good part, and the good part was certainly touted. That was the part that allows anybody within a county to transfer, to sell their property and purchase at least as an expensive or less expensive replacement property as their principal residence and maintain their Prop 13 base. That certainly was a something that was desirous of the electorate, and certainly rang true with them, especially since there were certain counties that did allow it, but others that didn't. Some allowed it inter-county, they didn't allow it outside of county. So what this did was it basically made all the counties have the same rules. So certainly a good thing from that perspective. You must be over 55 in order to take advantage of this transfer, and or disabled. And there actually is a third possibility, which is if you are a victim of a wildfire in California, then you would also be able to utilize this benefit provision. I give an example at the end of this slide that shows that if I have an individual who has a $500,000 Prop 13 base and the current fair market value of that property is $1 million, if they sell that property and buy a replacement property for 1.2 million, because the replacement property exceeds the value of the relinquished property by $200,000, the Prop 13 base would be increased by $200,000 in that example. So Yes, you get a benefit if you buy a replacement residence which is equal to or less than the fair market value of your current residence, but to the extent that that fair market value exceeds the value of the relinquished property, that will be added on to your Prop 13 base. Other than that, no other changes were made to Prop 13 as far as how the assessor will calculate and implement Prop 13 increases. So that was the good part. The bad part is that Prop 19 completely eliminated what are known as the Prop 58 exclusion provisions. So under Prop 58, parents were allowed to transfer their personal residence to their children, and the children would step into the shoes of their parents with respect to the Prop 13 base. That transfer was allowed between one or more children, and there was no restriction as to what the children then had to do with the principal residence. They could rent it out, they could live in it as their own principal residence, they could sell it for all that matter, but no restriction on the ability to carry over that base. What the change in Prop 19 did was eliminate that exclusion, severely limit that exclusion to primary residence only, as long as the child lives in it as their principal residence. So you can see a systemic problem with this. If I have more than one child, both of them would have to live in the residence in order to get that exclusion. The other aspect of Prop 58 was that in addition to a primary residence, you could transfer any other real property that had an assessed basis of $2 million or less. That now is out the window. So the only thing that's available to transfer would be the primary residence in which the child lives in it as their principal residence. So how do we get around this? So we do have some techniques that can work quite well as long as we understand the rules. So this slide basically talks about what it means to have a change in ownership. We all probably understand that if I gift the property, does that, or sell the property, I have given up the beneficial right to that property, and therefore that opens the floodgate for the assessor to say, aha, now without an exception, unless there is one, I get to value the property at its current fair market value. But what does that mean necessarily? Certainly it's very simple to say if I transfer property, all its rights and benefits, and your name is on the title, then clearly the person whose name is on the title is the beneficial owner. That is a transfer. But what happens if there's a transfer to, say, a trust for the benefit of a beneficiary? Or what's to say that we transfer a fractional interest in the property? How do we deal with those type of situations? So the law is fairly clear in that if we have, and this is the general rule, if we have a purchase or transfer of an interest in a legal entity, that transfer shall not trigger a reassessment of the underlying property as long as we meet certain thresholds. So let me back up. One of the strategies that we're going to talk about is prior to a gift or transfer of your real property, you would transfer that property to a legal entity, such as an LLC, could be an S corporation. Don't recommend corporations, but primarily we'll talk about the transfer to a LLC. Well, in that situation, we get a pass if the person who transfers the property to the LLC controls that LLC after the transfer. So a typical situation would be mom and dad would own real property. Let's just say it's not their personal residence. It's a rental property. They've decided for financial purposes and estate tax planning purposes to transfer this property to their children. Prior to the transfer, they decide to transfer it to a limited liability company. And the transfer of that real estate to the limited liability company would not be a reassessment event as far as the county is concerned, because again, mom and dad are simply changing the form of entity. So, but one of the two rules to really keep in mind here is, as long as control does not shift by more than 50%, then there won't be a trigger for reassessment. So, and this rule will become important when we talk about the strategy for transfer to an LLC. But again, let's just keep in mind that as long as we make transfers of property in an entity such that the control of that entity is less than 50%, there will not be a reassessment of the property. However, once we get to the point where that next transfer of that entity interest is more than 50%. So this is a cumulative calculation. Once we get to that point where now the kids own 50% and the parents own 50%, one more gift or one more sale of a 1% interest in that LLC will trigger property tax reassessment, not only just on the 1%, but on the entire property. So here's the strategy. I think you'll see this a little bit clearer as I make the illustration. So parents form an LLC and contribute the property, say it's rental property, and after the transfer to the LLC, the parents own 100%. Now what the parents are going to do is they're going to gift, and by the way, it doesn't have to be a gift, it could be a sale. We'll talk about some other techniques, but in this case, we're talking about a gift. So mom and dad could then gift their interest in this newly formed LLC up to, but not exceeding 50%. They're trying to avoid the property tax reassessment. At the point in time when mom and dad and the kids own 50%, we could just simply stop there. But if it was mom and dad's desire to continue to gift interest in this property, they would have to do something at this point. Otherwise, that one additional percent transfer to the children will trigger 100% assessment of the property. So we want to avoid that. So how do we avoid it? Well, taking advantage of the rules that we previously mentioned, if the entity, after it transfers 50% to the children, decides to dissolve and do a pro rata distribution of that asset, the real property, out to the partners in a pro rata situation such that the partners now own tenancy and common interest at 50%. Again, all we did was change ownership, entity ownership. So the assessor does not reassess the property on the dissolution of the LLC, as long as the distribution is pro rata to the existing partners. Nothing changed. Everybody owns the same percentage. But now here's the advantage. Now that the children own 50% and the parents own 50% TIC interest, now, as long as mom and dad transfer a TIC interest to the children in such a way that no one person will have more than a 50% interest after the transfer, there is no reassessment. Now, if we had done this strategy with one child, 50% to junior, and mom and dad own 50%, we now liquidate the partnership. We each take our 50% interest, and now mom and dad give a 1% interest to junior. Well, bingo. Now what happens is junior now owns 51% of the property and therefore triggers a reassessment. But if we had more than one child, we can easily see that a transfer of 1% interest to, say, two children, each owning 25%, would not trigger the reassessment. So the strategy here is to continue to make transfers. You can do that as long as the individual partners, no one individual partner, in this case TIC holders, own more than 50%. Now this slide does talk about the ability to actually reform a new LLC. You could certainly do that. You don't have to do that. Maybe for ease of compliance and that type of thing, it might be advantageous. You do have to be concerned, however, with the possibility that the assessor will, say foul, and this is a step transaction. All you really did was really transfer ultimately at 50% interest. I get a chance to reassess. So you want to have daylight in this transaction, the time between the dissolution of the partnership and then the recontribution of the TIC interest to a new partnership, should have some time, maybe a year. But again, you don't need the entity to continue on with the gift. Terry, I'm going to pause at this point and ask if there's any questions up to this, because I know I've kind of run through this really, really quickly. And as I told you, I can't see the chat. So does anything come up?
Yes, we have a question from Jesse Lane.
Yes. Hi, Jesse.
Jesse, I'm going to turn your microphone on so you can ask the question yourself.
Perfect.
Hold on just a second here. Okay, Jesse, you're live.
You got to take yourself off mute. There you are. Hi, Jesse.
Hi. Hey, Tim. My home is in a living trust.
Mm-hmm.
The trust specifies that after I die, the property is not to be sold until all the pets residing here have passed away.
Okay.
So I'm wondering, the questions, I've been wondering this ever since I saw this new proposition, is this condition or bequest, I don't know what you would call it, this restriction in the living trust, is that now in jeopardy?
Well, I don't think it's in jeopardy, but it depends on, so first of all, the pets can't own the property.
Right. The trust
So
owns
somebody,
the property.
so somebody owns it. So
The trust,
if,
it stays in the trust.
well, but who's the ultimate beneficiary of the trust?
Well, I've got three, a sister, a son, and
Yeah.
And a girlfriend, not yet a spouse, but
So if you wanted to maintain the Prop 13 base, then the trust should be written in a way that your son is the one who inherits the house and lives in it as a principal resident. So it must be parent-child,
He will never live here.
then you're out of luck.
Oh, for Christ's sake. You mean when I die, my pets are gonna, they gonna have to be not this, I can't believe this.
Well, they'll have to pay the increase in property tax. Yes. I mean, it will be assessed at date of death value, and anybody other than your child who inherits that property or a child that lives in it as a principal residence will get a step up, will get a reassessment.
Oh, but if let's say it takes 7 years for all the pets to pass away, and then the property is transfers out of the trust to my son.
Well, Jesse, what I would say is maybe you and I should talk offline.
Oh, okay, all right.
Yeah,
All right.
I think that the theme here is that people should be absolutely reviewing their trust and estates and saying, to the extent that I want to preserve that property tax assessment, and my trust says it's going to go to somebody other than my surviving child who's going to live in it, you're going to get reassessed.
Wow.
That's the bottom line. So if you want to change that, you need to change your will, or change your living trust.
Wow.
Were there any other questions, Terry?
No, that's it at this time.
Nope. Okay. So let's, so heretofore we talked about a gift of property. The assessor doesn't care whether it was a gift or whether it was a sale or whether it was a 1031 exchange. If there is a transfer of ownership, then there will be a opportunity to reassess. Now, rather than make a gift, you might, from a cash flow standpoint, as part of your personal financial planning, not want to just give it away to the kids. You certainly could have the situation where you could sell the property on an installment basis to the kids outright. And then the kids would owe you back, principal and interest on a note to be determined. So there's a lot of flexibility there. In the sale leaseback situation, we did this technique with personal residences prior to Prop 19. Again, doesn't make sense for a lot of people to give away their personal residence. They could sell their personal residence to their children and lease it back. Now, again, that would not, in that situation, if the children own the property and you do not, and they do not live in it, you're continuing to live in it, well, then that's going to be a problem. That'll be a reassessment at that point. Now, that's why we tried to squeeze these in before the effective date of Prop 19, because you could see this was a really great technique. Let's go ahead and sell the property prior to the effective date of Prop 19, and the kids now get the exemption, even though mom and dad are leasing it back, because there was no requirement for them to use it as their principal residence. That technique's gone, but again, you can still have the ability to transfer, sell, lease back, if it makes sense, those residences. I only mentioned 1031 exchange in that I think there's a misconception that you can't do a 1031 exchange with relatives. You certainly can. There are some restrictions, but let's just say that we had set up a partnership in which a property was transferred to the LLC partnership, and it was decided that we wanted to sell that property. And some of the partners wanted to do an exchange, and some of the partners wanted to just simply cash out. Well, again, in the context of the plan, which is transfer the property in, then do a transfer 50% ownership to the kids. Then at that point in time, liquidate the partnership, give a pro rata distribution of the assets out to the partners. Now, the kids could decide that they want to sell the property, or they may want to do a 1031 exchange with their undivided interest. Or the kids might be able to simply buy mom and dad out at that point, and maybe mom and dad could take the proceeds from that purchase and roll it into another real estate investment. So 1031 exchanges among related parties is possible. There are some rules that you need to navigate, but I just wanted to keep that in, top of mind.
Okay, Tim, we have a question from
Sure.
Jim. Question from Jim O'Day. Jim, I'm gonna allow you to talk now, so go for it.
Hello, Jim. Take yourself
All right.
off mute.
I did. Okay. The question I have is when the parents gift all or part of the property to the kids while they're still alive, don't the kids lose the benefit of the step up for income taxes?
That's a great question, and I'm actually going to address that in another technique.
Okay.
But you're absolutely right. That is the trade-off between, do I transfer property now such that I won't have a taxable estate, or it'll be outside my taxable estate,
Right.
or do I leave it in there and subject it to a 40% estate tax, such that my children can get a 23% benefit? That's kind of the way to look at it. I mean, I have a lot of clients who get angst over, well, if I give my property to my kids now, that means that when I die, they're going to have a capital gain. Yeah, but
Right.
would you pay 40 cents to save 23 cents?
Got it.
23.8, because that's what you're doing. The kids are, yeah, great. They don't have a capital gain, but they're only paying at capital gains rates, today.
Right.
So that's
Right.
that's the point. But there is a technique, James, that we can use that actually allows us to pull back property that we have gifted prior and include it in our estate such that there will be a step up. And I will touch base on that briefly.
Okay.
Time permitting.
Another quick question I have, as long as I got you.
Yeah.
I'm gonna specialize doing loans to irrevocable trusts so that the trust has enough cash to do an equal
Yes.
non-pro rata distribution. And so I interact with a lot of estate planning attorneys, and a number of them, because everybody was facing the deadline of February 16th, a number of them said, well, gee, there's really no hurry because the Board of Equalization came out with a letter responding to a number of questions on how to interpret Prop 19. And they said that the Board of Equalization said that as long as the second parent died prior to February 16th, then the old Prop 58 rules apply up to 2 years past that date of death, so that it extended Prop 58 for up to a year or two. Even though a lot of estate planning attorneys try to make the deadline, I think that a number of them feel they have plenty of time as long as the second parent died and effectively the kids inherited the property already. It's just that it's not individually distributed.
Well, I guess and I wasn't aware of that specific rule, but it sounds like, unfortunately, you have to die. One of the spouses has to die prior to the effective date.
Right,
So
right, yeah.
That,
So hopefully,
I could see that being an exception, but
right,
and obviously transfers between spouses are exempt from any property tax reassessment. But I am going to cover a technique that does involve an IDGIT, and it may answer some of your questions.
Got it. Thanks.
Okay, so I just threw this slide in because I wanted to remind everybody that you really need to do what you said you were going to do. So if we have a situation where we transferred property to children, you really need to respect the form of that transaction. I can't tell you how many clients I've talked to where they've gone ahead and done this. I mean, I was halfway down the road planning for one client to meet the Prop 19 deadline on a particular piece of property, and then come to find out she'd already transferred 50% of to her son about 3 years ago. Who knew? Oh yeah, I forgot I did that. He's living in the house, and I decided to give him 50%. Of course, no gift tax return was filed or anything like that. So I mean, it's very, very key to do what you said you did. If you're going to sell property to your kids, make sure there's a note. Make sure the note does in fact have the applicable federal interest rate. That is the rate that the IRS requires you to charge on interfamily transfers. They don't want you to charge too less. You can always charge a little more, but there is a minimum, and that rate is very, very low right now. But understand that there may be property tax, or excuse me, transfer taxes involved. You got to charge fair market rent if the children are living in the property, or the parents want to continue to live in the property. You do need to establish fair market rent. You may even want to get title insurance on the transfer. I heard that recommendation done by another attorney who'd given this presentation. And in a situation where mom and dad continue to rent the property or use the property, and therefore are paying rent, you better check your insurance policy, right? Because they're no longer the owners of the property. They are renters. So just some things to keep in mind if you move forward with this planning. So, oh shoot, I'm missing my one. I think I went too far. Well, I had a slide on intentionally defective grantor trust, and if for some reason did not get into my slide deck, but let me just talk a little bit about what that is. So if we are contemplating transferring property to children, many of my clients say, well, I'll be damned if I'm going to transfer that property to the kid. I mean, I have no control over what he or she's going to do. If there's rental activity, they get the money and they go blow it someplace else. So is there a way that I can effect a transfer that is effective for estate planning purposes, but gives me some control over whether they get a distribution of the corpus or principal? And yes, the vehicle, as James had mentioned, is the intentionally defective grantor trust. So what an intentionally defective grantor trust, or IDGIT, is simply a trust that is irrevocable. So we're all should be used to revocable living trusts. In fact, I think Jesse mentioned it. He said, my living trust says this. Well, living trusts are typically by their nature revocable. I can always rip them up. I can always change them. But a intentionally defective grantor trust is irrevocable. Now, it has the same characteristics, believe it or not, as a revocable living trust. In fact, as we all probably are used to, a living trust does not exist in the eyes of the IRS for income tax purposes. It actually, because it's revocable, really doesn't exist at all until there's a death. Well, in a situation of an irrevocable grantor trust, the IRS still views those as non-entities. They really don't exist from an income tax standpoint. So any transactions that you do with a irrevocable grantor trust are disregarded for income tax purposes. So if I set up a trust and I sell property to the trust, I just sold it to myself. See? So there is no gain on that transfer. If I took back a note for that sale, the trust is paying me interest payments on the note. That is not taxable interest to me. It's also not deductible by the trust, because again, it's as if I sold it to myself. So that concept is key in understanding why an intentionally defective grantor trust is one of the preferred trusts for purposes of transferring wealth and property, because not only do I continue on in the same vein that I did before, I'm paying the income tax on all the activity of that property that was transferred. If I transferred rental property, I am still paying the tax on the net rental income. But there was no taxable event, income tax standpoint, that resulted from that, but it did effectively transfer the value of my property out of my estate for estate tax purposes. That's the key, right? So again, from an income tax standpoint, disregard it. From an estate tax standpoint, a gift or sale or other transfer to an intentionally defective grantor trust is effective for estate tax purposes. So what, my clients have been focused primarily on spending their unified credit amount, okay? And I'm going to kind of turn this conversation into more of an estate planning conversation, because that's really what this should be. I know the focus was Prop 19 and how do we transfer property and not get a reassessment. Well, what's the underlying reason you're transferring the property in the first place? It's for estate tax planning purposes, right? That's really the primary driver. So you need to have a good estate plan in order to then plan around the Prop 19. So right now, everybody has the ability to transfer 11.7 million of property. And that privilege is likely to go away under the Biden administration, or at least be severely reduced. And it's statutorily going to go away in 2026. So the point is, transferring property today makes sense if you're going to have a taxable estate tomorrow. And that is the whole basically reason why we are transferring these properties. What better vehicle than the intentionally defective grantor trust, in that I get to control the distributions that go out to the beneficiary. I am paying the income tax on all the earnings, but that's as if I'm giving a tax-free gift to my kids anyway. So it is a great vehicle. And to answer, I think it was Jesse's question or James's question on the stepped up basis, what makes an intentionally defective grantor trust intentionally defective is it allows the grantor to substitute assets. So if I transferred a low basis and high value asset to my IDGIT, and prior to my death, I would like that property to be included back in my estate, I can simply just transfer other property to the IDGIT, usually cash. That transfer is tax-free, not a gift, but now I have the low basis asset in my estate. It will be included in my estate for purposes of stepped up basis, if the stepped up basis even survives. Of course, that's one of Biden's plans. So I am at the 10-minute mark here, and I've gone way over. I'm going to get one more chance for questions, and then I'm just going to wrap it up with some kind of random thoughts as to where I think 1031 exchange is going, and a comment on California taxation of PPP. So, Terry, any further questions?
No questions so far.
Okay. All right. So as we all know, the 1031 exchange is at risk again. Okay. I was going to talk about the final regulations on the definition of real property, but that's not so critical. There's a state law determination versus federal, and not need to worry about it too much. But what we do need to worry about is there is, again, a push to eliminate 1031 exchange for real property. We got kicked on personal property, so we can no longer transfer personal property in 1031 exchange. So real property is the only thing left. I think it is likely that 1031 exchange will survive in some shape or form, but I do believe that it may be severely limited. It may be limited to transactions of less than, $1 million. I don't know, I'm just guessing. But I think that there is a push to curtail or limit the ability to defer gain under 1031. Now, of course, the industry has all the ammunition that they've had in the past of why that's a bad idea to eliminate 1031. And in fact, I think in one of these slides, and we'll make these slides available to everyone, there have been studies done that says that the elimination of 1031 exchange would have a drastic effect on the real estate market. It would block transactions. People would hold on to bad properties. It would just kind of kill the activity. So if you are interested in writing your congressman, here is a website you can go to, talk to your representatives. I mean, they do listen to you. And I think you can have a voice and an effect. So one final parting shot for those of you that got PPP loans and were forgiven those loans. There was a controversy regarding whether or not the payment of expenditures with PPP loan proceeds was going to be deductible. So as we all know or remember, the forgiveness of the PPP loan was not supposed to be taxable. That was congressional intent. They forgot to tell the IRS that the expenditures paid would be also deductible. Congress fixed that, but California is digging their heels in. And so the latest thing that I saw was yesterday, an announcement by Newsom that they had reached an agreement on a compromise which would allow up to 150,000 of expenditures paid with PPP loan proceeds to be deductible, but only up to 150. So if you got a PPP loan that was more than 150 and you paid expenditures with that, those expenditures will not be deductible for California purposes. So here we go, creating differences between federal and California. But anyway, I hope that answered some questions. I think I snuck in some additional things that maybe you were interested in, maybe you weren't. I am available to answer questions now, and if there are none, just chat in your contact information to Terry, and he'll get those questions over to me, and I'll do my best to answer them.
Okay, Tim, I don't see any other questions coming in. So with that, thank you very much. Very informative session. I've seen other things done on a similar program, but yours really hit home in terms of simplicity and got right to the point. So we appreciate that.
Thank you.
Quick reminder, next Tuesday is Deals and Drinks. And we hope you can join us for that. It'll be Tuesday at 4 o'clock. And then we also have our chapter luncheon in February, actually March. It'd be March the 9th. Watch your emails for announcements about the nature of the program. So it's 10:55. Everybody have a good day, and we'll see you next week.
Thank you.